Hey guys, the popular ride-hailing app Lyft just went public for the first time ever, and the stock started to trade on the NASDAQ. Now there's a lot of hype around Lyft. For one, it's one of the hottest startups. It wasn't that long ago when Lyft and Uber basically started the wave of sharing economy, and now it's sizable enough to be a public company. And two, Lyft is a name that many consumers are very familiar with. Many people around the world either use Lyft or Uber to hail rides. And third, everybody's talking about it, which creates a feeling of FOMO if you don't buy the stock. In this video, we're going to talk about some things you should consider about Lyft before you buy its stock. By the way, if you haven't yet, consider subscribing to this channel if you want to learn more about finance and stocks. First thing to know about Lyft is its financials. Lyft had a very impressive revenue growth trajectory over the last 3 years, growing revenue from $343 million in 2016 to $2.2 billion in 2018. However, despite this growth, the business is suffering significant losses. The business operations lost about $700 million in 2016, and that loss steepened to about $1 billion in 2018. Now, this is what basically all the media is saying, focusing on the great revenue trajectory and the huge losses. But we think they're missing the point. The point here isn't whether Lyft is suffering losses. Many tech companies that have IPO have operating losses. The key question to ask here is whether Lyft has a path forward to reach profitability. If we look at the operating loss as a percentage of revenue, we can see here that the loss is becoming smaller and smaller relative to the revenue company is earning. As you can see from this chart, based on this trajectory, it is possible for Lyft to break even on an operating profitability basis in a few years. That's something to take into account, so you don't blindly base your investment decision based on whatever the media says. That being said, the market has some very lofty expectations for Lyft, and many people on Wall Street are betting that the company will miss these expectations and the stock price will fall. This leads us to our second point. There is a massive short bet against the company. Of all the Lyft shares that are traded on the stock market, over 40% of them were used to short the company. Said differently, over 40% of the company's publicly traded stocks were used to bet that the company's stock price will fall. This 40% is known as short interest. For reference, anytime you see a short interest greater than 10%, you should tread carefully. 40% short interest is humongous. Wall Street is betting against the company. And finally, let's think about the risk-reward dynamics of Lyft. Lyft is currently being valued at $25 billion of market cap. It's very risky because it's not yet profitable and it has a 40% short interest. Of all the other stocks that are available out there, why would you want to take the risk with the Lyft stock? Here's what Warren Buffett has to say.
I don't know whether the aggregate valuation they're talking about is close to 25 billion now or something like that. And I certainly wouldn't buy a business for 25 billion. I always think in terms of buying the whole business. If we buy 100 shares of General Motors, we think we're buying the whole business, and we multiply. If they've got, the billion, 200 million shares out, and it's selling at 35 or something like that, that would be 40-odd billion in the case of GM. So I look at what I'm getting as a part owner of a business, and I don't know why, with all the things you can buy for 25 billion in this world, that you would pick a business that really has to be earning 2.5 or 3 billion pre-tax in 5 years to even be on the same radar screen as things you can buy right now. So I have never been a big buyer we haven't bought an initial public offering, or I haven't, Charlie hasn't. I think since 1955, I bought 100 shares of Ford when it came out.
What did you buy?
What?
What did you buy?
It was Ford Motor. Gus Levy was running it as a favor, gave me 100 shares, and I have to admit it now, I think the statute of limitations has expired. I took a free ride on 100 shares and made $500, and it's the only time I've ever done that. But I was making $12,000 a year at the time, and 500 looked very good to me. But I think buying new offerings during hot periods in the market, I don't think it's anything the average person should think about at all.
You have said that you've missed out on some of those. Like you should have bought Amazon a long time ago. You should have bought Google/Alphabet a long time ago. Could this be one of those scenarios?
What was the last question?
Could this be one of those scenarios?
Oh, it always can be.
Yeah.
I mean, there were a pair of dice at the Desert Inn one time, many years ago. That no, they had them in a little case. They came up 32 times in a row. Well, that's what, 1,000 times a million times a billion times, 4 billion to 1, a little over. So you can go around making dumb bets and win. It's not something you want to take as a lifetime policy, though. I mean, I don't worry about. I worry much more about the things I do than the things I don't do. I mean, I missed all kinds of opportunities in my life, but you just want to make sure that you're on the side of the house when you bet rather than bet against the house.
And there you have it. So these are some things to take into consideration before you buy Lyft stock. Thanks for watching this video. And remember to subscribe.